All right, boys. So today we're going to be learning how to calculate financing when you're underwriting deals. Okay. And so we're going to start off with four fundamental components to financing. So this is just financing a term loan in general with a commercial bank. Okay. With a traditional bank, excuse me. So the four components, we have debt service coverage ratio, we have the net operating income, we have interest rates, and we have amortization. All together, you use these components to calculate your loan amount, okay? So there's going to be a bonus we're going to discuss at the end. It's a strategy used by top investors when your NOI is too low to get a term loan. But anyways, we'll get to that later. So essentially what we're going to be learning today is what the terms mean, why they matter, how to figure out what financing you can get and what you can pay for a property based on the financing that you could get. This is the financing that I use to transact on over 300 million of real estate. It's the same strategy that I use. Everybody I work with uses. Any top investors using these exact same metrics to calculate their financing. So it's the same with everybody. Okay, so we're starting off debt service coverage ratio. Okay, so the first thing that's super important is that commercial loans do not equal residential loans. They're different, okay? With a residential loan, you're usually qualifying for the loan based on your income, so your actual personal income. So if you have a job that pays you a lot of money, you'll get more loans. And if you have a job that doesn't pay you a lot, you're not going to get a lot of loans. It has nothing to do with how much your company generates. It has nothing to do with how much the asset generates. Like those things might be considered a little, but mostly it's based on your own income, okay? With commercial loans, it's all about the property. Obviously, they take into consideration your assets, your track record, your experience, all these things. But primarily, if the asset is actually a good deal, you're going to get financing. You'll get a commercial loan. Okay, so it's just completely different. And again, with commercial loans, it is calculated based on your debt service coverage, your interest rate, your amortization, and your NOI. So that's why we're going through those terms today. So what you need to know is how to calculate your debt service coverage. So your debt service coverage is just your NOI over your annual debt service. That's what ADS is. Annual debt service is we pay our mortgage on a monthly basis. So whatever your mortgage payment is times 12, that's your annual debt service. The cost to service your debt annually. All right, so you'll also need to know what ratio you need to get approved. So for example, usually banks will need like a 1.2 debt service coverage ratio. Sometimes they'll let you go as low as 1.1, 1.15. It depends on your relationship with the bank. It depends on how good the deal is. Depends on many factors, but essentially you could use around 1.2 to get a good estimate of what your financing would be. And then the question you have to ask as well is what if your NOI is too low? So I hinted at it earlier. I'll hint at it again. We're going to talk about that towards the end of the video. There's a way to get financing when this method wouldn't work, okay? Because if it's based on your NOI and NOI is zero, then this formula won't work. It won't produce any results. So you need to get financing even when your property is vacant. There is another strategy that we'll discuss afterwards that allows you to do so. So essentially, understanding NOI is why I switched to industrial real estate. I'll tell you guys a little story. I think you guys have heard this story many times, but essentially, when I first started calling, I would constantly speak to people that were telling me that they were leasing their buildings at 10 bucks net. Okay, at the time, I was being told that industrial rents were 5 bucks net. Okay, so after a while, I realized that rents had doubled in industrial real estate, but people didn't know about it yet. And the logic is that if your NOI doubles, the value of your property should double. And not only that, but your financing amount will essentially double as well, okay? So that's why it's so important, NOI. That was kind of the realization for me of how important NOI. Real estate is all based on your NOI. If you could increase the rent substantially, you're increasing the value of your property substantially. It's all connected to your NOI. So NOI affects the purchase price, like I said, or the sale price. It affects your debt service coverage because it's NOI divided by annual debt service. So obviously it affects that. Essentially, the higher the NOI, the better the loan terms you're going to get, assuming the purchase price of the property makes sense. Okay, so if it's market price or whatever the value of the property is, if it's a price that makes sense, the higher the NOI, the better the loan terms you're going to get. If it's overpriced, it doesn't matter what your NOI is, you're not going to get good loan terms no matter what. So just keep that in mind. Now we're going to discuss interest rates, which are arguably the most important aspect of loans and real estate in general. okay? So if interest rates are higher, your property value will be lower. When interest rates are lower, your property value is going to be higher. That is like a general rule of thumb. Real estate is so heavily tied with interest rates because real estate is all about leverage, okay? Why real estate is such an amazing investment is because you cannot get leverage anywhere else like you can get leverage in real estate. You can get leverage at low interest rates, long term, because it's backed by a safe asset that's a real asset. There's no other asset class like it. And because it's so tied to financing, it's so impacted by interest rates because if interest rates are higher, you're paying more money to service your debt. And if you're paying more money to service your debt, you could afford to pay less for the property. So yeah, they're very, very intertwined. I'll give you another example about how intertwined real estate is. Imagine banks all of a sudden overnight decided they're no longer lending on real estate. Real estate values would literally go to zero. Loans are propping up the value of real estate. Without loans, real estate doesn't exist. It would exist to a certain extent, but it would be a fraction of the cost of the value that it is today because you couldn't afford to pay the same values that we could pay because of the leverage that we have, right? Nowadays, when we look at a property's value, we consider we have to put in maybe 10, 20, 30% to buy that property. Imagine that didn't exist and you had to pay 100%. Real estate would go to zero. That's how intertwined it is with financing, and that's why it's so affected by interest rates. Okay, it's super important to understand that. So here are some questions we're gonna ask, and if you could answer these questions whenever you're, alone, thinking about real estate in general, then you'll have a good basis to understand how interest rates impact financing and how it impacts real estate in general, okay? So essentially, what are interest rates? It's essentially the cost of borrowing money. How are interest rates decided? They're decided by the economy, so monetary policy. So essentially, what we're seeing today is monetary policy, right? They're saying they printed a bunch of money during COVID, pumped that into the economy, then inflation went crazy. So what did they do? They started increasing interest rates. So you increase interest rates to combat inflation. You decrease interest rates to stimulate the economy. So monetary policy and the economy has a huge impact on interest rates. And then we have bonds, okay? Bonds are really how we're impacted in real estate, okay? So when we're going to get a loan to buy real estate, it's based on the bond market. And the bond market goes up and down based on investors that are looking at the economy. So I'm not going to go into too much detail on how bonds and interest rates are related. The only point I want to make is that essentially why they're so related is because if you're the bank, okay, and you're lending me money, no matter how good my asset is, there's a level of risk that you're taking that I could default on my loan, right? So you're comparing that level of risk to the zero risk investment of buying, let's say, the government of Canada bonds or the United States government bonds. If you essentially buying a bond for like buying a US Treasury or buying, the government of Canada bond, you're essentially loaning the government money at a specific interest rate. So there's zero risk in that investment, right? So a bank could always make that investment in those bonds. They could always loan governments money and get paid interest from that government. The only way they won't make that money is if the government goes bankrupt, which is if the government goes bankrupt, then there's a lot of other problems that you should be worried about, not just the loan on your asset, okay? So essentially, that's what they're looking at. And then they're tagging on a couple extra percentage points above that risk-free rate of return to determine what interest rate they'll give me because they need to make a bit more than a no-risk investment if they're gonna give me a loan. Following so far? Okay, so with all that being said, sometimes you hear people, it's like they'll look at the 5-year bond and they'll say they could get an interest rate for their acquisition, 2 percentage points above that rate. So let's say it's 5%, then they could get a loan at 7%. If it's 3%, maybe they get it at 5%. Some people, they have really good relationships with banks. Maybe you could get it up to 1%, 1.5% above the risk-free rate. But that's how it's related to bonds, okay? Now, if you want to calculate the effect it has on a property, essentially, you just use a pro forma and you're going to plug it in and you're going to see the impact it has on your returns, okay? But to make things simple, lower rates, higher returns. If your debt costs less money, then you make more money, okay? Very simple. How to predict interest rates. So obviously nobody has like a crystal ball. You can't just predict interest rates, but you could, I guess, make a good guess as to where interest rates might go in the future based on what's happening in the world, based on news. So you want to look at the state of the economy. If the economy is like exploding. Like basically little hints would be like, if there's like 100 offers on the same property and everybody's getting outbid and it's selling for above asking and interest rates are historically like all-time low or even just very low in general, like the economy is just flying, then you could probably think like there's no more room for the rates to go lower. So if I'm underwriting this deal, I have to kind of protect myself by assuming rates will probably go back up a bit more in the future. So you can make predictions that way. Okay, but again, news. And I'll tell you a little story about, I was speaking to a billionaire, right when COVID happened, okay? They were printing a bunch of money to stimulate the economy. And he was telling us that because they're printing all this money, it's gonna flood the markets with all this new money, and then we're gonna have a lot of inflation. And then he said, and at the time, interest rates were very low because they were trying to prop up the economy with low rates while everybody was at home and couldn't work, okay? So they're putting rates super low, then they're printing a bunch of money and inserting it into the economy, okay? So he was saying that it's gonna cause a bunch of inflation, and then asset prices are gonna rise because inflation increases the price of assets because it increases the cost of everything. So it increases the cost of assets as well. He made the prediction that that was gonna happen, so he started buying heavily when everybody else was kind of a little scared to invest because they knew nobody could work, everybody's stuck at home, there's this pandemic going on, they're printing a bunch of money, all this stuff. So a lot of people were kind of on the sidelines waiting to see what was gonna happen. They thought a big crash was gonna occur. He did the complete opposite. He made a bunch of massive acquisitions because he wanted his cash in assets because he knew asset prices were gonna increase in value. Then he also was explaining that once that cycle happens, asset prices will increase substantially. Now they're gonna have to combat the inflation that they just created and they're gonna start raising rates, okay? He called the whole thing and he was so accurate. And unfortunately, I should have made even more bets and investments based on what he had told me at the time. It's not that I didn't think he was right. It was just, I was earlier on in my career. If I was now that he had told me this, I would be in the perfect position to capitalize like 100 times more than I did at the time. But he couldn't have been more correct in his analysis. And so that's essentially one example of how you could potentially predict where interest rates will go in the future. All right, amortization, very simple. It's just how long it's going to take for you to pay off your mortgage or your loan or anything like that. Typical term, 25 years. There's an exception. I mean, with multifamily, usually the government allows you to get loans kind of backed by them. Essentially, it's insured by the government. And because of that, you could get way better terms. And sometimes you could get amortization up to 40, 50 years, which is like insane. But essentially, for us in commercial real estate, you could pretty much assume it's going to be 25 years. So now that we know about our debt service coverage, our amortization, our interest rates, and our NOI, okay, we could plug all those things in a calculator or in a pro forma or in however you want to use those values, and we could calculate the loan amount that we would get. Okay, it's as simple as that. So I'll make it very simple for this one. For me, I use a pro forma. For you guys, you'll use a pro forma as well. For anybody at home that doesn't have a pro forma, we'll be giving one away for free in another video. But for today, you could just go to a website called propertymetrics.com, or you could just Google propertymetrics.com, DSCR, or commercial mortgage calculator, commercial loan calculator, something like that. You'll find the calculator, okay? Then you just plug in these metrics. So your debt service coverage, your interest rate, your NOI, your amortization. The other stuff, just leave blank, doesn't matter. The other stuff will help you calculate your loan based on other metrics, but for this example, I'm telling you these are the metrics used by the bank to calculate your loan amount. The other metrics are also taken into consideration by the banks to calculate your loan, but usually you're capped by these things. So usually your loan amount is capped by these metrics. So even if you input the other metrics, it's always going to produce a higher loan amount, most likely, and the bank is going to give you the lower of the two. And so this produces the lower of the two. So that's why we use this, okay? The other thing to consider is in financing in general, the bank is not going to lend you more than your purchase price. So sometimes you do this and it'll spit out a loan amount that's higher than your purchase price. The bank's not going to lend you higher than your purchase price. And that's why at the end, I'll tell you about that bonus way to get financing when the NOI is low. You could also use it even when the NOI is high so that you could close on the property with that financing. And then later on, you could get this term financing with a traditional lender. And then they'll finance you not based on your purchase price because you already own the property. They'll finance you based on the income of the property using debt service coverage, okay? So now I'll just do a little calculation just to show you, okay? So for example, if you go to the site and you put your NOI at 500K, let's just say, then you do your interest rate, let's say 5%, debt service coverage 1.2, loan amortization 25, and then click it on yearly. It's set to monthly. I put it yearly. And then I go down, it says, so the maximum supportable loan amount per my debt service coverage of 1.2, I get 5.93959 million, okay? So let's say the asking price for this property is 7 million. I'll get a loan of 6 million, and then I have to put in $1 million of cash. Simple like that. That's how you calculate your loan amount. Now we're gonna talk about the bonus, which is a bridge loan, also known as a private loan from a private lender. That's usually the terms you'll hear. Essentially what a bridge loan is, just so you understand, is the term comes from you're getting a short-term loan to bridge you until you've increased the value of the property, in this sense, increase the NOI, so that you could then get your term loan with better financing terms from a traditional lender, okay? That's how you use a bridge loan, and that's where the name comes from. But it's the same thing as saying you're gonna get a private loan from a private lender. Any of those terms is the same thing as a bridge. You use this if the property has a ton of upside but low NOI, okay? So for example, the property might be vacant, but you know if you lease it, as soon as you lease it at market rent, it's gonna be worth a ton of money. That's one example. It could be that the leases are expiring very soon. It could be that there's a lot of work to do in the property. It could be a development. It could be for many different things. In this case, you won't hit the required debt service coverage, so the other loan won't work, okay? And so this is just based on the future potential of the property, and then they'll give you a loan to value on the cost of the acquisition. Simple like that. So essentially, I'll tell you an example of how we use a bridge loan to close a deal. It's pretty much the standard in commercial real estate because you need to get financing quickly. You need to be able to close on the property quickly. So for example, on one of the properties that we had acquired, all the leases were ending soon. And not only were they all ending soon, but we didn't even want to renew the leases because we knew when the building was vacant, we could go sell it to a user who will pay more for the property because he's using the property for his own business. So he could afford to pay a premium, whereas an investor, he needs a return on his capital. He won't be able to pay as much as somebody who needs it for his business. So we wanted to let the leases expire, and then we just wanted to sell the building vacant, okay? And if we didn't have a lot of traction selling the building vacant, then we could still lease it at market, and then we could get financing after that. So essentially, what we did is we said, we're gonna let it go vacant, and we think within a year, we'll be able to sell this thing. So we got a bridge loan, and yes, you pay high interest, but you get very high leverage. And again, it's based on the future value of the property. So they're okay giving us high leverage even though there's no NOI, because if they had to foreclose on us, well, they have a great property that they're getting. If you're getting money from a private lender that wants to foreclose on you, you probably shouldn't work with that lender, okay? You don't want to work with somebody who wants you to default on your loan, okay? You want to work with somebody who doesn't make money by taking over the asset and selling it themselves. You want to do a deal with somebody who's going to work with you to, give you realistic loan terms so that you don't go bankrupt and so that you keep your property, and all they care about is making the return on their money. They don't want to go and own the property and have to flip it themselves or stabilize it themselves. They don't want to deal with any of that stuff. Those are the private lenders that you want to work with. Bridge loan, very simple. All you got to do, contact a good mortgage broker, okay? Give him your financial statements, give him whatever he's asking for, give him the property information, everything related to the acquisition, the cost of it, the game plan, the upside, all that stuff. He's going to handle the rest for you. Some important notes about bridge loans and private loans, okay? You're going to pay higher interest rates, so maybe 10, 12%. Also, you have to pay a fee of the loan amount on closing, so maybe that's 1 to 2% just off the bat, and then you have to pay 10 to 12% annually, but in monthly payments. It's a short-term solution, maybe 1 to 2 years max, okay? You get higher LTV, like I was saying, higher loan to value, and it's interest only. So you're not paying off the balance of the loan, okay? When you get a traditional mortgage, the reason why there's amortization is because you're paying off principal and interest in every payment, okay? With a bridge loan, you're only paying interest, okay? So let's say I got a bridge loan of $10 million and it's at 10% interest annually. I'm gonna pay $1 million in interest over that year divided by 12, so I pay that monthly, right? And then at the end of the year, I've paid $1 million in interest and I still owe $10 million because I'm paying interest only. So it's loan amount times interest. That's the interest annually that I'm paying on that loan. Simple as that. When it comes to a mortgage, it doesn't work that way. I won't go into detail of how that's calculated, but essentially because you're paying down your loan, over time, you pay less interest and more principal. Your payment doesn't change, but you're paying more principal than you are interest as the loan balance decreases over time. So essentially, the conclusion is now you know debt service coverage, NOI, interest rates, and amortization, and you know how to use these things to estimate your loan amount. Plus, you got the bonus of how to use a bridge loan when the NOI is low to close on a property. You also learn how to use that to close on a property quickly, which is usually what you have to do in general in commercial real estate. But there's more. Essentially, on the next lesson, what I'm going to do is I'm going to teach you the different types of financing that you could get. So there's not only the term loan that I've been teaching you about today with the debt service coverage. I could go into more detail on the bridge loan in the next lesson, but then there's other financing terms out there, like essentially you have a private loan, which is also the bridge loan, but they're slightly different. We'll discuss those things. And then you have seller financing as well. You have a balance of sale, all these different other financing strategies that we'll discuss that we didn't go in here into detail with today. So we'll do that on the next lesson.
My question would be for DSCR, like I forgot, like you mentioned it's too complicated, I guess, to put in the lesson for how, like why it would be 1.1 or 1.2 or how did they get to that?
That is a good point that I probably should have discussed, but essentially it's 20%. So 1.2 means that your NOI is 20% greater than your annual debt service. So it gives them a buffer, meaning that if your NOI decreased by 20%, okay, you could still pay your debt.
So will your debt service coverage ever be below 1 or no?
No, if it's less than 1, then you can't even pay the debt. They don't want that, obviously. But obviously it could be that, and then the bank is kind of like acting as your private loan provider, your bridge loan provider, and they could give you better terms. And then they won't go off debt service coverage. They'll just go off of loan to value, but like it happens less frequently. So if it's less than 1, then you're going to need like a traditional lender, or they're going to just decrease the loan amount, right? So it's NOI over annual debt service. So if they just give you a lower loan, then you'll always hit the 1.2. See what I mean? So it's like you could always hit 1.2 as long as your NOI is not 0, right? But if your NOI is 250 grand, then to hit the 1.2 debt service coverage ratio, they'll just decrease your loan amount. And then if they decrease your loan amount, your annual debt service payment is less. Simple like that. That makes sense?
So would they ever allow a DSCR of 1?
In terms of like getting a traditional term loan with a bank based on debt service coverage ratio, like no, never. Like they'll maybe push it to like 1.1, but like they won't go less than that. Okay. They need some sort of buffer where if something happens, you could still continue paying your debt, right? Obviously, you might get your loan and then one of your tenants goes bankrupt and they could occupy half your building and then all the ratios are all fucked up, right? But that's why they also consider your balance sheet. They also consider your track record. They want to know, like, if there is vacancy, could you support it? Or are you just going to go bankrupt and say, fuck it? Mm-hmm. You know what I mean? So that's why these other things are also important.
Could a private lender ever be like just a random person, or do you have to have like a certificate
That's a great
for that?
Fucking question. It could be your family, your friend, your brother, it could be anybody.
So literally
essentially
anybody.
Like somebody is giving you a loan and they want it secured by the real estate usually. Even sometimes they'll give you a private loan that's unsecured. But like what I'm talking about is like it's backed by the real estate, like it's on title, it's a loan, like a bank gives you a loan. So anybody could act as a bank and give you a loan, and they could register a lien on title so that if you default on that loan, the security is they own the property that you just defaulted on the loan for. See what I'm saying? So anybody could do that. It could be me. I could give a guy a private loan and I could register a lien on title. So yeah, that's a great question. There's no requirement. You don't need any certificate. You don't need to go to school for it. You just have a bunch of money and you want a higher return. But obviously there's more risk, right? Because in a private loan, why you're charging a higher interest rate is because you're making a more risky investment, in the sense that like if the guy defaults or if he doesn't execute on his game plan, you lose your money. And yes, that happens even when they do it based on debt service coverage, but essentially with a private loan, the NOI could be 0. So it's like they literally have to go out of pocket to pay you the interest from day one. You know what I mean? So it's definitely more risky. So that's why usually when that happens, the guy's buying the property for cheaper than what it's worth. And so that if you did default and you had to take over ownership of the property and do something with it yourself, you have enough of a buffer to at least break even or still make some money. All right, so that's it for today's lesson. Make sure to subscribe, hit the bell icon to be notified when we release the next episodes. And also, thank you for watching. Love you all.